Even in an AI-focused world, MacroEdge is in the business of focusing on you. We don't just understand our clients, we listen to what's said and illuminate on what's not. In a world moving at the speed of light, with shifting markets, evolving workforces, and non-stop disruption, MacroEdge helps you to navigate and identify novel opportunities, expand your enterprise, and succeed in tomorrow's world. And it all starts with you. Put your enterprise and your perspective in the driver's seat. We're in the business of you.
Good evening, everyone, and welcome to MacroEdge Radio. It is Friday, July 11th, 2025. This is John Galt speaking. I hope everyone enjoyed their 2-week vacation. I know I did. And just when I thought I could go to the pool, chill out, relax, catch some rays, and do nothing, lo and behold, it was one of the craziest 2-week periods we've seen in markets, internationally, and domestically as far as politics goes that we've ever seen. We're not going to get into the politics tonight. That's for some other time. I'm really not into dealing with that. However, market-wise, there's a lot to talk about. And I'm just going to go through a quick market summary. Today, everyone's going to say, oh my God, the market went down. It's not a big deal when you look at the big picture. Dow down 279 to 44,371. S&P 500 down 20 to 62.59. NASDAQ down 45 to 25.85. There's your stock market. Volume was light, relatively speaking. Advanced decline was meh. New highs, better. Don't care. Really don't care. We have new all-time highs. The market has been bulled up as hell, and there's a lot of concern because of what's going on in the trade war. Back to that in a minute. Crude up $1.88 today to 68.45. Brent up 1.97 to 70.63. Gold continuing to be the big story, up 38.30 to 33.64. Silver, my favorite metal of the two, although I do love gold, up $1.65 to 38.95, briefly peeking its head above the $39 level. Bitcoin, new all-time highs this week. Right now up 1570 to 117,520. The story behind gold, silver, and Bitcoin is anything but the dollar. Don't care what anybody tells you. Don't care what anybody says. It's to avoid owning dollar-denominated assets and to have a hard or digital asset in your portfolio. Now, I'm not a huge Bitcoin advocate, but I'm also not a huge Bitcoin critic. There's times and places to criticize it with some of the crazy people making comments that XYZ coin of a obscene name is going to become the future of commerce. Not going to happen. However, Bitcoin is demonstrating something, and that is that people are hiding assets away from the dollar. The U.S. dollar Japanese yen was up 117 today to 147.43. So we've had a slight divergence to end this week where the yen is normally rising against the dollar. This time it fell and the equity markets fell, all because of the trade war. Dr. Copper had the most interesting move this week. On Monday, it closed barely at $5. It closed the week at $5.60, up another penny after the 50% tariff threat from President Trump. And tonight, of course, he doubles down and follows up, stating it will be not just finished products, but also the refined metals subject to those particular tariffs. The 50% tariff on copper, by the way, is catastrophic for the building, electrical, data center, and other industries. There is no way the American economy can sustain those levels of tariffs. And Chile has already come out asking for clarification because they're our largest supplier. Domestically, we produce a decent amount, but we don't refine and process as much as we used to. Why? Because we outsourced it to China. I'm going to take a pause right now because one of our regulars with the team, Six, is with us. I want to get his take on the markets the last 2-3 weeks. It's been a while since we've talked about this, Six. I find this disturbing and bizarre only because it seems like we've had way too many people get on one side of the boat. And when you start seeing penny stocks leading the volume, leading in trading activity on a daily basis, along with ETFs of stocks, et cetera, I just don't feel good with this level of speculation heading forward. Do you?
No, but I mean, I think it's been a pretty clear pivot the past couple months, away from, a deflationary kind of trade environment to now we're kind of moving back into a reflation regime. Metals are ripping. The broad commodity indexes are not ripping, but metals specifically are doing very well. Tariffs probably help that to some degree, and then obviously gold, Bitcoin, um, and then the rally in the indexes has been pretty narrow. But assuming that the indexes as a whole are able to hold above the previous all-time highs that we saw in, I believe, February. The second half of the year probably is a safe bet to start looking at, um, uh, you know, laggards in the market catching up. You're going to have fund managers who are underexposed to equities and have large cash positions. That's in the long only managers. They're going to they're facing career risk now. Underperformance as a long only manager of the benchmark is like career suicide for them. And then you have a lot of hedge fund managers who have large short positions on, which is hard to totally discern because a lot of that could just be hedging in the futures market. So the futures positioning is not necessarily totally indicative of, their overall net leverage ratios. But this week, for the first time, I've started to think that really, we all make jokes about the Fed should be hiking because this shitcoin is going through the roof. But for the first time this week, I really felt that the Fed should start to look at the next move as a hike instead of a cut, which is interesting because Trump is just not going to allow that to happen. So if the Fed cuts here and employment doesn't roll over before they do it, I think that then the next thing that's going to happen is that long bond yields are going to break out of their channel that they've been in for several years now, where they basically, the 10 years been oscillating between mid to high threes and five. And if the Fed cuts into this with the predominant narrative in markets being fiscal irresponsibility and wide and broadening deficit spending, I think they're going to lose control of the long end of the curve if they force the Fed into a cut here. And that will actually be the next big challenge for equity markets, is long bond yields blowing out. Probably globally, if it happens here in the US. Japan is already starting to see that. And what's interesting about Japan is that they have had their long bond yields creeping up pretty aggressively, in a trend like fashion for a while now. And that has been on the back of, a hotter inflationary environment in Japan. But now inflation in Japan is starting to roll over, and the Japanese long bonds are still going higher in yield. So it just kind of tells the story of like where we might be heading. And now I've been thinking that employment was about to roll over, but the employment data, at least on the surface, we can argue about weak private payrolls and continuing claims making new cycle highs. But if you look at the continuing claims chart, it's off of a very low base, and while it is creeping higher, it's not starting to explode yet. So I mean, until it starts to explode higher, I can't let that get me too bearish. And if it does, I'll quickly change my mind. But it's starting to look like the reflation is going to be the bigger issue going into the final stretch of the year, and that's what I'm kind of starting to think about and how to position for that.
Well, I'm going to throw a curveball at you. I don't know if you saw Michael Hartnett's latest from Bank of America. I'm cheating because I read Samantha LeDuc all the time, one of our guests that we've had on before. The trading rule that he uses when inflows to global equity and high yield bonds exceed 1% of assets under management in 4 weeks, sell. Past 4 weeks, inflows to global equity and high yield bonds equals 1%. Sell signal triggered for the first time since July of 2024. A very interesting perspective, if you ask me.
I agree. I just don't see what the catalyst is going to be. And I'm not sure that we really need one because valuations are so stretched. But when I see things like, so year to date, the administration has basically told us exactly what they're going to do. And they told us at the beginning of the year that they're not watching the stock market. The stock market's not driving the results for this administration. I'm not looking at the stock market. And then all of a sudden, April 9th, Trump said buy. And, I had traded the first leg of the year very well. I did not get bullish enough price would dictate that I was wrong. I did not get bullish enough when he said buy because I did not think that things could turn on a dime the way that they did after he had already introduced so much anarchy into the financial system. But we continue to see that impetus from the White House. I could not believe it when I saw the White House account post, the nothing ever happens faced guy looking out the window to like nuclear bombs of green candles. But I just can't, I can't get too bearish when they're doing that. They're doing all of these different things that are just massively bullish. The activist treasury policy that they're doing right now, where they're not only terming in the debt by heavily issuing on the front end, reducing the weighted average maturity, which pushes risk out the risk curve. They're also doing treasury buybacks at the long end. So I mean, what they're doing now, in addition to running wide and broadening deficits, is they're effectively stimulating by terming in the debt. And it's similar in nature to quantitative easing. And as long as that's still happening and the administration is still obviously looking to support risk assets, I, I just can't get bearish until something changes. And I don't know what it is yet, and I'm looking for it. But I think that the best opportunities in the second half of the year are just going to be, being selective below the index level. I'm not really too interested in the mega cap names at all. They're all overvalued. Those stories have all kind of run, in my opinion. They could go higher maybe, but there's a lot below the surface. There's a lot of different thematic sectors of the market that they have strong structural tailwinds that really got hammered when the tariffs happened, and they have not recovered. And I think that that's probably going to be the best opportunities in the second half of the year as far as equities go.
Well, I'm going to be honest, in full disclosure, I got back into the juniors, silver and gold, back in May, and I don't disclose positions. I don't propose that anybody else follow my advice or anything. I'm just telling you up front, and that was because I bulled up on, if this reflation trade does occur, it's going to be off the charts. I tend to think you might be right, and I'm going to respectfully disagree on one thing. There's a famous U.S. Treasury Secretary quote from a summer many, many moons ago, roughly saying that there's no cause to worry, the high tide of prosperity will continue. And he sounded exactly, if not identically, like everything we're hearing from Bessent and Hassett and Navarro and the rest of the crew in the White House. And what bothers me about that, Six, is there's too many people on one side of the boat. And being the eternal skeptic and contrarian that I am, I always fear that once too many people get on that side of the boat, you have to prepare for the worst case scenario. And I just don't think a lot of the younger traders on Wall Street and retail wise are hedged enough for the risk. And my number one risk right now is the war on Jay Powell on the Fed. Obviously, Jay's not going to cut to 1%, but a demotion of Jay Powell, as I wrote about last week and predicted on the MacroEdge Sunday night feature, I'm telling you, folks, this is well within Trump's power, and he could easily demote him as Fed chair to just a governor or a vice chair or some arbitrary position within the Fed where he still has a governor's title. And that's perfectly within the law and legally acceptable according to the Supreme Court, dating back to 1948. It's going to be awful tough for the markets to digest a Federal Reserve chair being forced out and replaced with a yes man. And the bond market, and I'm warning you people right now, the bond market damn sure will never accept such an action. It will rebel. And I'm talking a 30-year going right over 7% before you can get to the date of September 30th. It's a scary proposition, but you can't have enough precious metals in your portfolio if that were to occur.
Yeah, I mean, I would agree with that. And if he removes Powell, I mean, that's probably what's going to happen. I think the next major risk really is just bond yields blowing out. I'm kind of surprised that they're creeping higher now. 30s are brushing up against 5. 10 years not even over 4.5 yet, so that's nothing crazy there. But if he forces out Powell, or if the Fed starts cutting again, I think they're going to lose control of bonds at that point, especially with everything else they're doing. There's just no offset for all the fiscal that they're doing. They're publicly saying that we're going to run it hot. We're going to grow our way out of debt. Trump thinks that Trump tweets things that indicate that he thinks that I mean, he was a commercial real estate developer, and in that sector of the market, the best credit quality gets the lowest rate, and he seems to think that that's how sovereign yields work. Sovereign yields trade on nominal GDP, current and future expectations, and inflation and inflation future expectations. They do not trade on credit quality. So, I mean, they do to some extent, but more than that, it's inflation and nominal GDP, and he just doesn't seem to understand that. So if he forces rates down to 1% while they're doing 7-8% deficit spending, they're going to lose control of bonds. They just will.
That's what terrifies me, is losing control of the credit markets. And to be honest, the one thing that I'm seeing now, which should terrify the living hell out uh, of Trump, I know it worries Besant, but the Japanese are looking, and the news in Nikkei this morning was absolutely amazing, are looking at possibly uh, increasing their rate of decoupling from the United States at every level: industrial, trade, financially, and of course, security. Now, Japan is fully capable, if they were to apply themselves to taking care of their own country. They could create their own nuclear weapons anytime they wanted to, although they're banned in their constitution. It would require some changes. But the reality is, technologically speaking, they are fully capable of doing everything and anything that we can build, and do it at the same pace, and probably build some things a little bit better, perhaps like ships. The reason I throw that out is, if we lose Japan, South Korea will follow, and China will have the entire East Asia region to themselves as trading partners. They won't have to go to war because we're going to be so weakened if we have to finance our own debt. But that brings a great question from Don the Gang. What do you make of the concept of yield curve control? I just don't see us doing it under Powell. However, under one of the if God forbid, if that idiot in the White House becomes Fed governor, Fed chair, but if people like that suddenly get in charge, it's entirely possible we'll have yield curve control, and we'll have all kinds of third world banana republic instruments, which will make us a giant size Argentina, financially speaking. The risk level increases dramatically, and it looks like the taxpayer is going to have to eat it.
Yeah, I mean, I don't know how they could cut down to like 1 or 2% like Trump wants to without doing yield curve control. So whoever in the Fed, whoever they would put in the Fed, and that's not to say that all the governors would even go along with it. I mean, the Fed chair does wield a large amount of control over the board, but you wouldn't be able to cut to 1% without doing yield curve control, especially if you're trying to grow nominal GDP above trend. It's just the math isn't mathing, as the kids say.
Yeah, I'm sort of scared about this whole prospect because he's insisting that Apple relocates all of their factories out of India to the United States, where we just spent the last 6 years beating on Tim Cook and Apple to relocate all their plants out of China to India. I happened to listen to one of my favorite financial shows this evening, and they were saying that Bangladesh is no big deal. It's not a criticism of the host; he just doesn't know. But we all have some mutual friends in the retail business, and we know that Bangladesh, which had a severe penalty tariff imposed on them this week by Trump, is a key nation for affordable apparel for the lower and middle class. And we seem to dismiss this, but in the short term, it is extremely inflationary to increase prices 30 to 35%, and in some cases 50%, like Brazil, as he's talking about. When you start seeing those kind of actions in conjunction with the theory of forcing rates down, and Bissett does have some power to do that to a degree. He could just issue a buttload of short-term bills instead of trying to do his long-term 3-3-3 plan. I fear what's about to happen is going to get pretty ugly pretty fast. And we have somebody who wants to join us here. Let me get him on the air. Joseph wants to join us here in a second. Six, your take on that, because I just don't think there's an understanding of the impacts of this trade war at this point in time and what will be the impact on the American public.
Yeah, the way that I think about that is that the tariffs will cause the K-shaped economy to become even more K-shaped. If they're running wider deficits and they are terming in the debt, juicing liquidity by doing that, it creates a fertile field for speculation for financial assets, and financial assets will probably still perform well. Meanwhile, the low to lower middle tier consumer is going to become even more stretched. So, I mean, in that case, you could have, the bottom part of the economy just in near shambles while markets still just perform very well. That it's a very interesting dynamic, and I really don't know how that one plays out. But I would expect the wealth gap to become even more stretched if the tariffs persist at the same time as they're doing all of this financial alchemy.
Well, Six, before you go, let me bring Joseph on. I think he has a question for one of us. Go ahead, Joseph.
Hey, Macro. Joseph here. Yeah, it's actually kind of a clarification. You were talking about tariffs on apparel. And in my work experience, I've actually worked the books for companies like Esprit Decor back in the day, for the North Face, for Union Bay Apparel. And I can tell you, when it comes to apparel imports, the cost for the cost for the apparel is pennies on the dollar of whatever you see in a store here in the United States. So even though the tariffs might seem substantial, from my experience, when I'm looking at the actual books on costs for the goods that they're being sold at in the United States, it's negligible. It really is. So even if you might see a 30, 40%, tariff or whatever the percentages are, it doesn't really impact that much in the way of the dollar amount you pay in a store here in the United States. It's really insignificant. And I wouldn't know this because I've seen the actual books at major manufacturers in the United States that import their goods from Asia.
Well, the only reason I bring that up is we've seen an extreme amount of margin compression already because of foodstuffs and groceries on the mega stores like Walmart and Target. They're going to pass this cost on somewhere.
Yeah,
There's no choice.
I'm just saying, I'm just saying in this particular sector, in apparel, when you're talking about the tariffs on apparel imports from Asia, and that's all I'm talking about, that one particular sector. When you're talking about like shoes, you're talking about shirts, pants, jackets, anything like that that's coming from Asia. You're really paying almost nothing for those goods. It's pennies really. It's pennies on the dollar. What you would see at a store here in the United States. So even though the tariffs seem substantial on those sectors, it's not really a big deal when you're to see it in the end here at a retail in the United States. It won't be significant that it's going to have any real measurable, like, oh my God, like, what am I paying for this item effect? It's not going to have a sticker shock when you're looking at it. I'm not saying that's going to be the fact on other sectors necessarily, but in this particular sector for apparel and shoes and such, it does.
Got it, sir. Okay. Thank you for your perspective, Joseph. Six, I got one thing else to add to this, by the way. I think he's brought an interesting point into this. But did you see the stat that I posted this morning? I don't know. I know you're busy during the day, but I posted an article this morning talking about all of this. And one of the things I noticed was that we're at a level where household and other institutions, per the Federal Reserve statistics, are more invested in stocks right now, equities and equity funds, than during the dot-com bubble. Is that disturbing to you?
Yes, but I mean, I totally believe it. Now you have things like Robinhood and Webull, and it's never been easier to get into the market. Going off that, it's never been less profitable for a broker. The brokerage firms have all had to pivot into wealth management and payment for order flow, and that's another funny part of the new brokerage regime that we're in is spreadless. Like you go on Robinhood and you buy a stock and they just eat your spread like never before. But it's widespread speculation now, and all that we've seen in the aftermath of the GFC is that tech stocks go up. People have seen that. That's all they know. When I come across incoming investment transfers that I then have to reallocate, it's the usual suspects every single time. Tesla's usually the biggest holding when I get inbound retail dollars that have been self-allocated to that point. It's always Tesla, and I like to play a little game with it and ask why they like Tesla, and they don't even know. I mean, not a single one of them really even knows. They wouldn't be able to tell you what the PE ratio is. Not only what the number is, what that metric is. So it just goes to speak to the current environment, really.
Well, the reason I bring that up is I found that disturbing also because the one big beautiful bill basically mandated that we're going to create $1,000 stock funds to keep the big five brokerages in business for the next 3 years guaranteed, and that'll probably get renewed for newborn babies. It's an amazing thing to see and watch. And for those of you who are not aware of that, yes, there is a Trump baby fund that was passed in the one big beautiful bill. I think it's great there's a retirement fund established for kids. If people want to do it, that's fine. But if any of you think that it's going to go to mom and pop brokerages, you're out of your damn mind. It's going to the big boys. It's not going to be invested in Bitcoin. It's not going to be invested in anything but an S&P index fund. And eventually, when we see yield curve control or a problem with our bonds, there will be mandatory investments allocated over to U.S. Treasuries. That's just reality. Real quick before we move on, macroedge.net/ozone, macroedge.net/ozone. Make sure you sign up for your 2-week free trial, macroedge.net. Hit the ozone, see all the other features we're offering. Check out Six's Fund. We've got a lot going on right now at MacroEdge. It's worth your time. Get your free trial, check it out, see what you can do from there. You'll learn a little bit. A lot of us learned a lot. All right, Six, I got one more question for you because this is really turning into an interesting thing. You and I were talking about speculation. I watched crap biotech that's been around forever that went from $700 down to 5 cents and then spiked back up over $1 this week on 1 billion shares and then come right back down. At what point do we actually get a Securities and Exchange Commission to start putting red flags on all of this craziness? I just can't see this level of speculation continuing until something breaks. It really is scary as hell.
Oh man, if you think the SEC is coming in on this one, we're moving in the opposite direction. Regulations are getting looser, not tighter, and that's probably going to persist. They like what's going on in Washington right now. They're all for it. Unfortunately, fortunately or unfortunately, if you're long stocks, probably fortunately. If you care about society, probably unfortunately.
Well, that just basically tells me that we're about to have something crazy go on, because usually when we see that, that's usually a marker for the top. Although I'll be honest, and I'm going to write about it this week in 6 just to let you know. I honestly think that the Superman poster from the White House today is without a doubt one of the markers of a top coming or at this point in time. 6, thank you for your time this evening, sir.
Thanks, John.
Clayton is joining us, one of the sharper minds we see in the MacroEdge crowd. Clayton, how are you doing this evening, sir?
What's going on, John?
Not much, man. Not much. It's a Friday night. We're all chilling out, just checking things out, looking at the insanity, trying to figure out what 5-cent stock's going to be a $5 stock on Monday.
Yeah.
Love to hear your perspective, sir.
So personally, I have about 5 different people that I look at, and one of the people is David Keller. I think he's a phenomenal technical analyst, and one of the things he pointed out at the beginning of the year was there was a Hindenburg omen that fired. And it wasn't just a Hindenburg omen, it was a confirmed Hindenburg omen. And those almost always precede bear markets or big corrections. And on top of that, you have several other people like Wayne Whaley, you have Grant Hawkridge, and Darius Dale. You have something I look at is when all of these people put out studies that all correlate together and they show everything trending in the same direction, while retail and speculation is all going in the opposite direction. Usually that's a big telltale sign. But something I'm seeing right now is everything is trending in the same direction. And when I look at Wayne Whaley's study or Jason Geofert's or even Grant Hawkridge posted some charts today showing that every sector in the S&P is above its 200-day now, and the average forward 12-month returns from their studies, granted it's probably only about 5 cases, is 30% for the S&P. So something personally I like to think of is, if that's the truth, and if in the past we had 5 different instances of 25% corrections or 20% 20% corrections and 25% rallies in 3 months, and the forward returns on those were always 30%, I like to think, what could possibly cause that? In the next 12 months, what has to be the narrative to cause a 30% rally in the S&P? And right now, that's what I'm trying to think of. And I don't know if the momentum in the mega cap names and the AI narrative attached to it, I don't know if that's powerful enough to propel the indexes 30% a year from now. So I'm trying to think of what could that potential catalyst be? And if they are wrong, then those same people, I hope, much like in December, they'll post the same studies and the momentum will be shifting to the downside, and we'll know ahead of time. But right now, everything seems to be pointing in one direction.
Well, you and I have been around on X long enough for you to know that I'm probably one of the bigger contrarians. So
yeah,
I always want to be known as the last bear standing, no matter how many times I get shot. Uh, but to be honest, by the way, Darius Dale flipped bullish
Yeah.
just last week. So it really bothers me when he flips bullish. But now David Rosenberg is starting to backtrack a little bit and starting to show concerns. And he was perpetual perma bear, and then he switched somewhat bullish, and now he seems to be phasing back to bearish because he seems to think that the risk of a deflationary event occurring due to the tariff war is increasing. Is that the kind of trigger you're looking for in the near future? And I'm not saying tomorrow, obviously. I'm thinking next quarter at the earliest, perhaps.
For a catalyst to the downside, you're asking?
Yes.
Um, right now, I'm not necessarily looking or thinking about catalysts to the downside, mainly because all these studies seem to be trending in one direction and trending up. So right now, I'm trying to think of what could potentially be a catalyst to the upside. And that's why my mind is going to biotech, AI merging with or integrating within like biotech technology like CRISPR, AlphaFold, AlphaGenome, and how fast those studies are speeding up, and and that could potentially all it takes is a couple headlines and articles in that type of speculative area to propel maybe the market. I'm not entirely sure, but it could form a new narrative. So right now I'm looking at catalysts to the upside.
Well, when you look at a catalyst to the upside, if Six is correct about a reflation trade, which is technically an inflation trade because there's nothing to reflate, we've only had a flattening out more than anything. If we see more money pumped into the system, because I don't think that the one big beautiful bill stimulus really hits until the first quarter of next year, which would make sense since we're finishing up this fiscal year and a lot of the spending is not going to really roll into it until after October. Um, if we start pumping heavy monetary policy plus treasury incentives into the economy, that would seem to me to be extremely inflationary and contrary to what the bulls really want. But then again, I've been wrong about the bulls before. They might be quite happy with $5 a loaf for bread and $10 a gallon for gas in the short term to interim term, as long as we get Dow 50, 60, or 70,000.
That's a possibility. That makes sense. The only thing I have to ask, because you know more about this than I do, when they crank up uh, M2 or liquidity and they inject it into the system, is there, I could be wrong, but is there a 12-month lag with inflation, or is it immediate?
Well, it depends. If it's a reduction in the Fed funds rate, that's a 6 to 9 month lag time. Increasing in two is a direct result of increasing in federal expansion, treasury bills being generated, cash being created, and the Fed having to participate also create the cash on order. In my opinion, the bigger risk is going to be overheating the economy in a very short term manner. At the same time, you're having this trade war. I just can't see a win-win scenario until next year. Now, next year, I think I'm probably going to get more bulled up than anybody, barring a deflationary collapse in demand. But if we can avoid a deflationary collapse in demand in the second half of this year, I see no reason to see why an inflationary path isn't going forward. And as Six quite aptly said, you can't own enough commodities, miners, or commodity stocks moving forward. Look at what a 50% tariff will do on Brazil with coffee alone. It might just save the coffee import business because prices were cratering. They finally got it under control with the weather changing, and now we're going to increase the prices on beef, orange juice, and coffee from one of the largest people we import from all in one shot, creating a hardship on the lower class, the bottom part of the K. Whereas the people who invest in equities and hard assets are going to be like, great, I can make more money off of that.
And there's something, I'm pretty sure Tom McClellan just posted one of his studies recently that showed inflation is going to tick up in the second half of the year too. So that would also go along with your theory on if they inject more money into the economy, then inflation will rise. But then if you couple that with all these momentum studies saying that the market, apparently the NASDAQ in the next 12 months has never even had a 10% correction. So it would be interesting to try to think of a world where there's going to be a bit of inflation, there's going to be a lot of money injected into the economy, and asset prices are all going to rise. And that goes along with your theory as well, as that would be the economy overheating, which then there would probably have to be a cool down period unless we're just running fiscal dominance forever and we're just going to keep expanding deficits and printing. But I think your theory on overheating the economy aligns with everything that I'm seeing right now.
So you're on the same wavelength. My fear after what I think is a short-term scare is that if we do see deflationary impacts starting to hit the economy, we're not going to become Japan. We're going to become Weimar, basically, and we will take the gamble on somewhat hyperinflating, even though we say, oh, well, we're only going to do a little hyperinflation, not the full bore hyperinflation where we print dollars and everybody needs a wheelbarrow, a little bit pregnant, and pump this sucker up just to keep asset and equity prices higher. In the meantime, the destruction that will occur to the underlying economy, especially the lower 60% of the population, I'd say 70%, would be absolutely devastating. I just can't see a balance there where this ends without some sort of reversion to the mean in the near future. And all of us talk about this, but we say we haven't had a reversion to the mean. We're still hearing this talk that the business cycle's been defeated and that the recession, no more recessions ever again. And I've seen this in history over and over again. Clayton, from a market perspective, where you really top off on this, besides the speculative sectors you listed, what sector concerns you the most that's not participating? From my personal experience and expertise, and I'm not claiming to be an expert by any stretch, but where I was and what industry I was in, the transportation group is still sending warning signals across the board, and that needs to be listened to. I'm not by the way, I'm not promoting Dow theory. That's an expired theory, in my opinion, because of how the Dow transports are constructed.
I actually have not looked at the Dow transports, so I'm just going to pull it up. If I'm looking at a very short-term view of it, it's above its 200-day right now and just broke above it. I'm not entirely sure. Do you see there to be it seems to be tracking fairly closely with the Russell 2000 index if I'm looking at it just as an initial look. So could you potentially see the transports and the Russell 2000s catching up with the indexes, or do you think they're not going to?
I don't think they're going to, because I think that we're about to see a decline in trade. I think that this is part of the V-shaped recovery, and for the transports to actually get back to new all-time highs, it's still a good 1,500 points away. I still think the transports are sending a warning signal despite the recent rallies, and I'm looking at a 5-year chart right now. We haven't even broken back above the levels from late 23 when the market initially broke out and started sending warnings. And now we're looking at the levels from this past autumn, which were well above 17.7, and we're still at 16.2. I just can't see the transports maintaining their current velocity, especially with forward projected container activity starting to decline, trucking companies going bankrupt left and right, and now the railroads are starting, with CSX today, number one, starting to announce layoffs in management. There's something telling me that they're expecting a slowdown in the near future, and that is a red flag for me. If transports aren't showing bullish momentum in the next 30 to 60 days, I think this sucker rolls over hard. I think the rest of the market catches up to the transports again, not vice versa.
In that the hardest part to grasp about everything seems to be the K-shaped economy, because it seems like no matter which path we go, the bottom percentile of households just get decimated. And that's why I posted the Elysium picture a week ago, because it seems like that's the direction we're heading, where we just have policies that will make the rich more rich, and then the bottom percentile just gets crushed until Elon Musk or somebody gets elected with their America Party and tries to fix the deficit.
Yeah, I agree with you. Sure. I'm with you on that. I honestly fear that what we're going to have is a economy that appears healthy on the surface, but the underlying lowest 50 percentile gets crushed. My fear with the deflationary scenario, and I'm just going to go ahead and state this openly, is for those individuals who are 70 years or older whose homes are still being financed or being paid off, and the valuations of those homes crash, but they still have the expenses and their stock market valuations crash. We could crush not just the younger generation, but the older so-called boomer wealth generation that everybody makes fun of on social media and the internet. It's a very dangerous game we're playing right now from my perspective of the central banking system. And that's the wild card. I don't even think it's the big banks this time that are going to be the problem. I honestly believe it's the central bank and the political aspects of that are going to come to a head. There's no way you can map that out technically, though. That's the scariest part.
Yeah, and I get that completely. Yeah, I'm not entirely sure what the future is going to hold, but I appreciate you having me on, and I love listening to the podcast, listening to your guys' opinions. Thank you.
Sir, and if you're not following Clayton, promote your link on X, because you provide some very insightful posts, especially on technical analysis and other aspects for people to read. Promote yourself, sir.
All right, I appreciate it. My @ is just at Clayton Charts. I just post things that I find interesting, and yeah, that's it. Post my opinion. Sometimes I'm trying to tone it down a little bit. Sometimes I let my emotions get a hold of me. I start shit posting, but trying to tone it down a bit. Only post charts. So,
Clayton, thank you so much, and we appreciate you participating with us, sir. Thank you very much, buddy. There you go, folks.
Yeah,
one of the best, one of the sharpest minds that I've talked to on the X in a long time, and somebody who provides a different perspective. You can find people like this at macroedge.net/ozone, macroedge.net/ozone. We try to provide a diversity of opinion and stuff. We've got the super bears, the super bulls, and the crazy people. I'm more of a historian, uber bear, and I'm uber bearish because I'm skeptical of data until I can see validation and verification of data. I just can't buy it. I'm a hard numbers person, and all of the emotion and talk and sentiment indicators are nice. Everyone talks about the Michigan Sentiment Survey. They talk about JOLTS. They talk about the weekly claims. And this is not a slide at 6 by any stretch. I am so skeptical of the weekly claims data. I look at the non-seasonally adjusted weekly claims data versus the report that you hear on the mainstream media. So when you hear 227,000, for example, that's the official seasonally adjusted. Now, I'm sorry. If you know anything about the state unemployment claims, it's a hard data point. It's not seasonally adjusted. It's not something where you go, oh yeah. Well, because it's this week, there's 7,000 more normally. No, it's not that way. It's a hardcore actual data point that you can't deny. Let's take last week's data. I'm going to pull this up off the Department of Labor. I don't have the latest, of course, that never fails. Oh, here we go. June 14th. I'll just pull up June 14th, for example. Your seasonally adjusted is 236. The non-seasonally is 245. There's your split. It's not a big deal. If you go and read the weekly reports, you can see it posted. They talk about it. It's not what you think it is. It's a data that's been politically laundered in many cases to try and manipulate market opinion. And that is where the danger comes in. If you start reading things skeptically, you can find opportunity, in my opinion. And that's just my 2 cents. Couple things that I want to get into real quick. There's an emerging theme that's starting to hit the market, and it's a concern of everyone. And that is what's going on August 1st. There is a degree of skepticism because of the taco trade. Trump always chickens out. The question is, what happens when he doesn't chicken out? And no one has actually sat there and thought that through. Markets damn sure haven't. A lot of index traders haven't. A lot of equity honks haven't. And no one who is thinking long term has thought that through. Honest to God speaking, I think the taco crowd is absolutely in a lot of trouble right now the minute he sits there and puts his foot down and decides to stay firm. And if we sit there and stay focused on that, everything you're hearing from him, copper, Brazil, Canada, Bangladesh, Taiwan, South Korea, Japan, you name it, it is about to turn into a potentially damaging long-term play as more nations steer away from doing business with the United States. We've looked at what happened with Brazil, and Brazil sat there and said, today, Lula came out. He's a damn communist. No other word for it, folks. But he said, we don't have to do business with the United States. We don't have to submit ourselves to this. We just won't buy their stuff, and we'll sell our goods overseas to other people if they won't buy it. It's not that we won't buy their goods. It's whether our stores, our intermediaries will pay the tax for Brazilian goods. In a lot of cases, we're going to have to eat it. If you think you can sit there and not import coffee into this country, I present to you a situation that would make the Boston Tea Party look like an old lady get together playing bingo. And we would have a revolution on our hand pretty goddamn quick. I will tell you that right now. Number two, the metal situation has flipped on its ear. We were told that precious metals were for old people who sit there and collect retirement checks. Gang, the young people just haven't figured it out yet. They think that the digital currencies are going to be the future, and they have some degree of accuracy in that. There's a lot of future in that if you can access it. However, the advantage to the currencies of silver and gold, platinum and palladium, you can actually hold those in your hand. You can actually lock them up. You can have them roll into a van down by the river during a hurricane for secure safekeeping. The problem, what we're witnessing right now is that years and years of suppression and cyclical changes to the world economy is about to impact, especially as far as relations to the dollar valuation. Prepare for impact. As I wrote this morning, the silver panicans are coming. And when they hit, that gap between $48 and $75 per ounce for silver is going to be a nightmare for those who are short and for those industries and those particular companies that didn't buy hedges or hedge ahead and invest in silver at lower prices. It's going to happen, and that will only make the price go higher. As the dollar devaluation and dismissal continues and accelerates, we shall see precious metals being hoarded by central banks and being hoarded by individuals, especially when you see people like in the nation of China begin to accumulate it in the numbers and volumes that they are, cause the prices to hit levels we haven't seen in over 40 years. Next week on MacroEdge Radio, I'm not sure who we're going to have on as a special guest, but I'm going to try. We're all going to work on some people to get on here. We're going to probably talk a little bit of everything once again. I appreciate Six and Clayton for hopping on the air with me tonight. We will be doing a real estate show soon. Melody M3, by the way, at M3_Melody, a frequent guest on this program discussing real estate, is out in Purcellville, Texas with Travis, working rescue operations. I'm going to go ahead and plug, if you can go to M3 Melody, she has a link to the church that she's working with. If you can contribute, please do. She's doing the Lord's work with a rescue team out there trying to help find remains and or people. So please help if you can, guys and gals. It's a very important effort. For MacroEdge Radio, this is John Galt speaking. We'll catch up to you next Friday night, 8 p.m. Good night now.